What I like to look at is Bitcoin priced in gold, because Bitcoin priced in dollars kind of is boring to me. You can tell, to me, when does the real bull market start? When we make a new all-time high in gold. So let's pull up the weekly chart. You can kind of see here the trend of Bitcoin demonetizing gold. And so the first all-time high we made was Bitcoin was worth 15 ounces of gold, then 30, and we're kind of at this level. At one point, Bitcoin was 40. This was late 2024. And so for people that are like, we made all-time high, we made all-time high. Yeah, we did in dollar terms, and we should celebrate that. But, we have not, made all-time high in my opinion yet. This is what I'm looking for.
Bitcoin may be making headlines for its price surges in US dollars, but that doesn't necessarily tell the full story. In today's environment, where inflation runs hot and fiat currencies feel increasingly fragile, dollar-based milestones can seem more like illusions than meaningful achievements. Real value, many argue, should be measured against something timeless, something resistant to manipulation. That's why some investors are shifting their perspective and asking a more compelling question. How does Bitcoin stack up against gold? For Jack Mallers, this isn't just a thought experiment, it's the lens through which he evaluates Bitcoin's true progress. While others cheer new all-time highs in dollar terms, Mallers is watching a different chart altogether, Bitcoin priced in gold. To him, that's where the real story is unfolding. Over the years, Bitcoin has steadily gained ground, climbing from 15 ounces of gold per Bitcoin to peaks near 40. It's a slow but powerful signal that Bitcoin isn't just coexisting with gold, it's chipping away at its role as the ultimate store of value. This isn't just about numbers on a chart, it's about a changing narrative. If Bitcoin can break its previous highs in gold terms, Mallers believes we'll be witnessing more than a market rally. We'll be seeing a generational shift in what humanity considers sound money. And that's a much bigger deal than another spike on a crypto exchange. Let's watch clips from Jack Mallers' interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Since I last spoke to you all, Japan bonds plunge. The BOJ is retreating from the Japanese bond market. Japan bonds plunge, and we've got issues because when the Japan bond market and those yields start to heighten, the US bond market gets messed up. And the theme of today, as that we've talked about on the show over and over and over and over again, is the existing financial system that's been the result of post-World War I, post-World War II. It's starting to unravel. It's starting to fall apart. And Bitcoin, in my opinion, is going to be it's going to play some role in the future financial system as a neutral reserve asset, an asset that's based on proof of work, that no one can print, that everyone has access to. It's inclusive, it's divisible, it's transferable, it's scarce. Okay? So this show, we're going to break down the existing financial system collapsing in front of our eyes and watch the world adopt what I think is the greatest monetary invention in the history of our species. So this week, Japan had issues in their bond market. Guys, it's like a house of cards, okay? If one card falls, it starts to cascade them all. When Japan has issues, the US bond market has issues. Let's step through it. So, immediately, Trump's next hurdle, the bond market hates his beautiful tax bill, right? Okay, so the theme is US yields skyrocketed again. We saw bond market volatility again. Japan's having bond issues again. And Scott Bessent has come out and has not been shy about his opinions and his thoughts on the bond market, okay? So he's come out and said, Moody, who downgraded the US credit, is a lagging indicator. It does not matter. He's come out and said that we have to focus on the deficit to GDP and that it's the highest outside war of out of our recession. So here's what I've done today, guys. I've pulled up Scott Bessent's interview. So since the bond market has gone absolutely haywire, I've pulled up his interview and keyed it with each time he's gone to the media and said how he's going to print money, how he's going to debase the dollar, how he's going to try and get the United States out of this problem. Anytime monetary authorities want to change something, they cannot surprise the market. They cannot surprise the market because the market cannot take volatility. A highly leveraged financial market cannot take free market volatility. It cannot take prices going up and down and the free market trying to figure out what's going on. It can't sustain that, okay? And so what financial authorities do is they tell you in plain English exactly what they're doing and what's going to happen, okay? This is what people don't understand. Like, Jack, how did you know this was going to happen? Because I'm listening. All I'm doing is I'm listening. These guys are telling the market exactly how they're going to print the money, exactly where the money printing is going to come from, exactly how they're going to juice financial assets because they cannot catch the market off guard. If they catch the market off guard, the free market, it's going to be volatile, and volatility is going to kill a highly, highly, highly levered financial system. Okay? So let's step through it, shall we? This is the interview I've been dying to show you guys. Let's listen in.
Several components there. So if we unpack it, there is the growth, the potential growth of the debt. But what's more important is that we grow the economy faster. So what we've seen under the past 4 years, and what we inherited, I inherited 6.7% deficit to GDP, which was the highest deficit when we were not at war, not in a recession. So we've been trying to bring down the spending, and we are going to grow the revenue side. So we are going to grow the GDP faster than the debt grows, and that will stabilize the debt to GDP, which even Secretary Yellen and I agree is the most important number.
Let's focus and zoom in here. We're going to dissect Secretary of Treasury Scott Bessent and all he's doing to debase the dollar, prolong this financial system, which means weaker dollar, stronger assets, scarce assets like Bitcoin should perform. He says our focus is to grow the economy faster than the debt. That's how we will stabilize debt to GDP. Now, let's take a look at this tweet from Warren Pies. Warren's comments, Moody's downgrade equals no big deal because there's no chance of not getting paid back by the United States, but there's a high chance of getting paid back with a debased currency, okay? So Treasury Bessent saying Moody's downgrade was no big deal. They can downgrade the U.S. credit. No problem. Who cares? Those guys are lagging indicators. We're focused on growing the GDP faster than the debt, okay? Warren does the calculations. 97% public debt to GDP plus 3.2 primary deficit plus 3.4 effective interest rate, equals U.S. must grow the GDP at 6.6% to keep debt to GDP stable. U.S. must grow at 6.6%. So in order for Bessent to get away with what he's claiming, it has to grow 6.6%. Now, why is that number relevant? Let me tell you guys, this has happened 4 times in history, in U.S. history. This has only happened 4 times, okay? What are those 4 times? The dot-com bubble, the everything COVID bubble, and the housing bubble. Outside of those 3 bubbles, the only time GDP has grown 6.6% or higher is high secular inflation, the 2 decades where inflation was out of control, which was 1965 through 1985. When a man tells you who they are, believe them. Believe them. Bessent says, I have to grow the GDP faster than the debt. Okay, 1 second. Which means you need either extremely high inflation or an asset bubble. What have I been saying on this show over and over and over for a year? These guys got to juice assets. These guys need a weaker dollar. These guys are going to base the currency. These guys are going to reorchestrate global capital flows. And these guys are going to juice assets. And they're telling you the asset they want to juice. Gold, Bitcoin. Not tariff gold, setting up a Bitcoin strategic reserve. So step number 1, listen to what the guy's saying. He's telling you who he is. When a man tells you who he is, believe that man. Believe that man. He's saying 6.6% GDP growth against the debt. You need an everything bubble, mister. That comes with inflation. Never in the history of our country have we seen that much GDP growth without money printing. Japan's bond market just cracked,
and the ripple effects are already hitting global debt markets. It's not an isolated event. It's a sign that the foundation of the post-war financial system is starting to give way. As yields spike and deficits balloon, the world is waking up to a harsh reality. We're entering a new era where the old rules don't apply. In the chaos, scarce assets, those that no one can print, are quietly becoming the safest bets. The US is drowning in debt, and bond salesmen are now the frontline firefighters. Behind the polished press releases and patriotic sound bites lies a desperate scramble to find new buyers for government debt. Any buyers? Wall Street's playbook? Deregulate, repackage, and offload risk to the private sector. Meanwhile, fund managers are overloaded with bonds and dangerously underexposed to real assets. According to Jack Mallers, when the music stops, all that capital will need a safer home, and it won't be in paper promises. Let's watch more clips from the interview.
At the end of the day, I think Scott Bessent is super smart. Brilliant trader, brilliant fund manager. I'm sure he's an awesome and nice guy. None of this is personal. But you have to keep in mind who he is right now. Who he is right now is a bond salesman. That's who he is. The next 4 years of his life, he has a boss. His boss is Donald Trump, and his job is to make sure the U.S. government can finance itself. And he does that by selling bonds. So at the end of the day, no matter what this guy says, he's trying to get someone to buy these dog shit bonds. And so we're going to focus on deregulation. We're going to unlock the American growth by getting all these like handcuffs off of the innovators. Is a really clever way of disguising dollar debasement, inflating assets, putting us in an asset bubble by a tremendous amount of liquidity positive, unlimited leverage for the banking system. Next, this was huge, okay? I'm giving very serious consideration to bringing Fannie Mae and Freddie Mac public. I will be speaking with Treasury Secretary Scott Bessent, Secretary of Commerce Howard Lutnick, and the Director of the Federal Housing Finance Agency, William Pulte, among others, and will be making a decision in the near future. Fannie Mae and Freddie Mac are doing very well, throwing off a lot of, all caps, I love this guy, cash, and the time would seem to be right. Stay tuned. Okay. Why is this a big deal? For those that do not know, Fannie Mae and Freddie Mac were taken under the U.S. government in the housing crisis, okay? And the U.S. government absorbed Fannie Mae and Freddie Mac in their entire balance sheet after the financial crisis, okay? There's been talks recently of making Fannie Mae and Freddie Mac a private business again, which means unleashing it from the U.S. government's balance sheet and making it operate like a normal company. Just like a JP Morgan Chase, or just like Bank of America, or just like Wells Fargo. It's just like another financial services firm with a massive, massive, massive balance sheet. Okay. Why is this interesting? This is interesting because the private sector would have a brand new, highly levered balance sheet to buy mortgage bonds. Okay. Basically, I've been trying to think of ways to simplify this. Think of it this way. The U.S. government is running out of people to sell their dog shit bonds to, okay? They need new buyers of their dog shit. So let's recap how they've been finding these buyers. One, we know about the hedge funds in the Cayman Islands, and Bessent saying he'll implement treasury buybacks, right? Okay. So that solves for these hedge funds that are just running arbitrage trades. They don't actually care about the price of the bonds because they're just arbing. They're buying the physical, they're selling the future. It's an arbitrage trade. They need a lot of leverage. Bessent's going to provide them the leverage through treasury buybacks. Number two is a supplemental leverage ratio. We just heard him talk about that. That is making sure that U.S. banks can take U.S. consumer deposits and with unlimited leverage buy these dog shit bonds. They still need more buying power. The U.S. is in so much debt. They have so much financing to do. $36 trillion of debt. Refinancing this at 4.5% is so expensive. They need another buyer. So what do they come up with? They take a government-owned balance sheet and they puke it out to turn it into a private company that can in return go buy their dog shit. We've seen now, like Jamie Dimon, Warren Buffett, all of these that say Bitcoin should be at 0, Bitcoin's overvalued, it's at 110,000, it's time for a correction. Is this the peak of the bull market? Blah, 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 right? What I wanted to show you guys is this is a study, May 2025, okay? Look at the date here, done by the Bank of America. Look at the bottom right of this screenshot, B of A Global Research. So know this data is not old, and know this, I'm not citing a small bank, I'm not citing an anonymous Twitter researcher. I'm citing the Bank of America, okay? Global Research in May 2025. Looks like fund managers are really overweight bonds. Look at the top two things they own, utilities and bonds. Utilities and bonds, okay? So anyone that's gonna tell you, man, like there's way too much risk in the market, you know, Bitcoin's been on a run, it needs to come down. If you look at research and take a look under the curtain of what fund managers have allocations to, they're swimming in bonds. They're swimming in the thing that's going to get them killed or that's already gotten them killed. Okay? Now, if I go to my next one, this is their exposure, same research, same global research. This is their exposure to equities. So obviously we don't have on here Bitcoin. If Bank of America reported, you know, how much fund managers were buying Bitcoin, that'd be awesome. But the closest proxy is equities, right? This risk on, risk off idea. And so this notion that like we're running hot, this is the beginning of the bear market. Listen, this is my personal opinion. You take it for what it's worth. But fund managers from Bank of America research, underweight on equities, overweight on bonds. It's another way of saying we're just getting started. Do you have any idea how much money is going to have to leave the bond market that's about to get murdered and killed due to money printing, negative real rates? People aren't overweight risk. Look at this. They're not overweight risk. Everyone fled the equities market after Liberation Day. Look at this, look at this data. So for all these people that come out and say, yeah, Bitcoin had a nice run, sometimes you get lucky, now it's going to 0. We've barely gotten started. Do you know how much money is trapped in bonds that needs a new home as soon as Bessent starts just gushing out the money printer?
Bitcoin may be holding strong above $109,000, but cracks are beginning to show beneath the surface. Technical signals are flashing warnings, momentum is weakening, and the 30-day rate of change, ROC, is diverging bearishly from price action. It's a classic sign that the rally could be losing steam, even as Bitcoin clings to its bullish channel. A short-term pullback to the $100,000 mark wouldn't be surprising, especially with the MACD flipping negative and momentum fading despite news of massive capital inflows, like Trump media's reported $3 billion crypto buying plans. Yet, zooming out reveals a much bigger story unfolding. The bond market is showing stress, and traditional assets are facing declining real yields. Meanwhile, fund managers are still overweight on bonds and underweight on equities, let alone Bitcoin. This imbalance is unsustainable in a world of mounting debt, negative real interest rates, and relentless monetary debasement. Jack Mallers has argued that the real signal of a Bitcoin bull market isn't just price. It's when capital begins fleeing legacy assets and flows into something no one can print, dilute, or control. That's where we're headed. Whether or not Bitcoin briefly dips, the long-term trajectory remains intact. When traditional investors realize they're holding melting ice cubes, bonds that can't keep up with inflation, they'll have to find a new home for their capital. Bitcoin, scarce and decentralized, remains the most likely destination. What we're seeing isn't a peak, it's a pause before a much larger reallocation begins. As we wrap up, do you agree with Jack Mallers that Bitcoin priced in gold is the real indicator of value? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.